What's up, guys? So these are going to be the top 5 stocks for earnings next week. As we can see on our screen, tons of companies are reporting earnings. So we do know it's going to be a volatile week, and we have a lot of big tech companies reporting earnings as well. We're not going to be covering everything, just the top 5 biggest companies. And the first one is going to be Apple. Apple is a solid company. They do pay out a pretty nice dividend at 0.5%. Now, it is a low dividend compared to other dividend stocks, but this is one of the top 500 companies. It's a big growth tech stock, and usually with these huge companies, we don't see dividends because they're focused on growth. But Apple has decided to throw in a pretty nice bonus of 0.5%. So shareholders are experiencing some pretty nice dividend reinvestments by holding Apple stock. And it's pretty nice because when stocks are flat, dividends are a great way to grow your money. So Apple is also a great stock to sell cash secured puts on as well, which is basically when you sell a put, you're trying to get shares of the stock at a lower price. So Apple is a very good stock for that. Next up, we have Amazon, similar boat as Apple, pretty similar in the price point where it's pretty affordable for some people to sell cash secured puts on. As you can see, we're currently selling a cash secured put on Amazon for next week, and we sold it for a pretty good amount, around $100-something. So we're making that much money on that. But Amazon is a very solid tech company. They recently underwent a 20-for-1 stock split. So now it's very affordable for a lot of people with smaller accounts to buy whole shares of Amazon. And they can also sell some cash secured puts, covered calls against those shares to make some nice monthly income. So Amazon, very solid tech company, and it is kind of where it was before the pandemic. So it is at a pretty good price point, in my opinion. A lot of tech stocks have seen some significant downturns. As you can see, Amazon is down 33% the past year. So very nice discounted buy, in my opinion. So pick up some Amazon shares now. So next up on our list is going to be Google. Same boat as Amazon. They underwent a 20-for-1 stock split. So now it's pretty affordable for people to sell some cash secured puts or even sell some covered calls against those shares, just because it's more affordable stock price at $108 per share. So very, very similar position as Amazon, a very big tech company as well. They do not pay out a dividend. Similar to Amazon, they don't pay out a dividend. They're mainly focused on pure growth. So Google is a pretty nice company to buy over long term. As we can see, it is up 120% in the past 5 years, but it is a volatile stock because it's focused on growth. And market downturns such as this one, it is going to be a little bit volatile. So we are down a little bit in the past year, but right now at $108 per share, it is a great buy, especially since it is down negative 5.6% since last Friday. Next stock on our list is going to be Microsoft. Microsoft is always a solid company and is similar to Apple. It does pay out a dividend at 0.93%, so it is a little bit better than Apple in terms of dividend yield, but it is going to be a little bit pricier at $260 per share. So most people cannot sell cash secured puts or covered calls on the stock, but a lot of people can afford a few shares of the stock to enjoy that healthy dividend yield of 0.993%. Microsoft is a little bit more stable than these other stocks. As you can see, it's only down less than 10% in the past year, whereas these other companies are down 15%, 20%, even 30% in the past year. Microsoft is pretty stable, it's pretty steady. As you can see, the past 5 years, it has some really stable, steady growth over the long run. So you can't really go wrong with Microsoft as a solid company in your portfolio. And next up on our list is going to be Meta Platforms, which is a pretty controversial stock on this list. They haven't been doing well in the past year, as we can see, negative 53% in the past year, mostly because a lot of people are not really using Facebook as much. They're really starting to sweat, in my opinion. What they're banking on is the metaverse. As we can see, they changed their name from Facebook to Meta Platforms. They're really putting a huge investment into the metaverse, and if that takes off, that's where this stock is going to see some exponential gains. So it is going to be a riskier one on this list, probably the most riskiest one. It's very volatile. As you can see, in the past 5 years, it's pretty much given up all of its gains. It's only up 5%, which is pretty crazy. Highs of around $378 per share, and we're currently half that. So it's pretty It's pretty bad for Meta or Facebook shareholders. They don't pay out a dividend either, but right now it is at a stock price where you can sell some cash carry puts on it if you have a few $10,000 in your portfolio, which I do have right here. But Meta Platforms is going to be a little bit of a gamble. If you do believe in Mark Zuckerberg, if you do believe in the metaverse, then this stock is definitely the choice for you. So as we mentioned earlier, lots and lots of companies are reporting earnings. So be careful out there. If you see a stock on this list, make sure you do your due diligence and research before buying any of these companies or playing any option strategies. Thanks for watching.